Silver's move toward the $90 level did not arrive with the kind of headlines most market participants expect. There was no single catalyst, no dramatic policy announcement, no coordinated central bank signal that clearly explained the repricing. And that is precisely why this move matters. In well-functioning markets, large price movements are usually accompanied by a widely accepted narrative. Inflation expectations change, interest rate paths shift, currency regimes wobble, risk premiums reprice. But in silver's recent advance, the explanation lagged behind the price. Analysts scrambled to retrofit reasons after the fact, while traders debated whether this was momentum, positioning, or something more structural. This disconnect between price action and narrative is not new, but it is rare at this scale. When an asset begins moving decisively while consensus explanations remain fragmented, it often signals that the market is responding to pressures not yet visible in public data. In other words, price is leading information, not reacting to it. For professionals and researchers, that inversion should immediately raise questions. The first question is deceptively simple. Who was forced to act? Markets do not reprice violently on optimism alone. They reprice when participants are compelled to adjust exposure. That compulsion can come from margin constraints, inventory mismatches, delivery risks, regulatory changes, or balance sheet stress, factors that rarely make headlines in real time. Silver occupies a unique position in this regard. It sits at the intersection of monetary perception, industrial necessity, and derivatives-heavy trading infrastructure. Unlike purely financial assets, silver cannot be conjured digitally to meet sudden demand. And unlike purely industrial commodities, it is deeply embedded in leveraged paper markets where exposure often exceeds physical availability by orders of magnitude. When price accelerates in such an environment, the critical issue is not whether the move is justified, but whether it reveals a constraint that had been quietly building beneath the surface. Another question follows closely. Why now? Many of the macro themes cited after the move, inflation persistence, geopolitical fragmentation, energy transition demand, were not new. These factors had existed for years without producing a comparable price response. The timing suggests that something changed not in theory, but in structure. Structural changes do not announce themselves loudly. They appear first as friction, settlement delays, inventory drawdowns, unusual spreads, rising lease rates, quiet shifts in who is willing or unwilling to provide liquidity. To the casual observer, silver moving toward $90 may look like just another volatile commodity cycle. To a trained eye, it looks more like a stress signal, one that the market has not fully interpreted yet. This chapter is not about predicting where silver goes next. It is about recognizing when a market move is asking a question rather than providing an answer. And right now, silver is asking several questions that consensus models are not equipped to address. In the chapters that follow, we will examine what those questions are, why they emerged at this moment, and what they imply about the deeper structure of the silver market, both paper and physical. Because when price moves ahead of explanation, the most dangerous assumption is that the explanation will eventually catch up. One reason silver's move toward $90 unsettled the market is that it did not originate where most models expect price discovery to begin. The early pressure did not come from visible retail demand or headline-driven speculative flows. It came from tension inside the structure itself, between paper pricing mechanisms and physical constraints. Paper silver markets are designed for efficiency. Futures, options, and derivatives allow exposure to be expressed instantly, at scale, and with minimal friction. This system works exceptionally well when physical availability is assumed to be elastic and delivery risk is treated as theoretical. Most of the time, those assumptions hold, but they are still assumptions. Physical silver operates on a different clock. Supply is slow, much of it byproduct-based, and cannot be expanded quickly in response to price. Industrial demand does not pause simply because volatility increases. Strategic buyers do not reverse procurement decisions because charts become extended. Physical reality does not hedge itself. When paper prices rise rapidly under normal conditions, physical markets are expected to respond by releasing inventory, increasing supply, or moderating demand. That response helps restore balance and reinforces the idea that price leads reality. What made this episode different is that physical signals did not confirm the paper narrative. Instead of easing, physical availability appeared tighter. Instead of premiums collapsing, they remained resilient. Instead of supply stepping forward confidently, it became selective. None of this constituted a public shortage, but it did suggest friction, and friction is where structural stress first appears. Markets tend to misread this stage because they expect confirmation to arrive quickly. When it doesn't, the divergence is dismissed as lag or noise. But persistent divergence is not noise, it is information. For professionals and researchers, the key question is not whether physical silver has run out. That framing is simplistic and rarely accurate. The more relevant question is whether the confidence in availability has narrowed. When confidence narrows, behavior changes long before statistics do. Participants begin to act differently. Some reduce reliance on rolling paper exposure. Others pay closer attention to delivery mechanics. Liquidity providers reassess the terms under which they are willing to intermediate. None of these actions are dramatic. Together, they matter. Silver's structure amplifies this effect. Because the paper market is large relative to the physical base, even modest changes in physical confidence can have outsized effects on pricing. The system does not need to break to reprice. It only needs to become less forgiving. This is why focusing on headline explanations, inflation, geopolitics, sentiment, misses the deeper signal. Those factors may contribute, but they do not explain why the move happened when it did or why it unfolded the way it did. The move toward $90 coincided with a moment when paper assumptions encountered physical hesitation. That hesitation did not stop the market. It redirected it. Importantly, this does not imply inevitability. Divergences can persist for extended periods without resolution, but once they appear, the market is no longer operating under its prior framework. It is testing a new one. Understanding this distinction is essential. Silver's recent move was not simply a bet on higher prices. It was a reaction to a misalignment that models are slow to acknowledge. To see how that misalignment begins to influence broader market behavior, and why it often remains underestimated, we need to examine how participants adjust once confidence, rather than price, becomes the primary variable. Once paper and physical signals stop reinforcing each other, the market's center of gravity shifts. Price is no longer the dominant variable guiding behavior. Confidence is, and confidence, unlike price, does not move smoothly or transparently. In the period following silver's move toward $90, the most important changes did not appear on charts. They appeared in posture. Participants became less willing to assume that conditions would normalize automatically. Exposure was still taken, but it was managed more actively. Liquidity was still present, but it was offered more selectively. The system continued to function, but it did so with narrower tolerance. This is a critical distinction. Markets under stress behave differently from markets under constraint. Stress produces volatility and visible disruption. Constraint produces caution. It slows decision-making, tightens margins for error, and raises the importance of timing over conviction. Silver's structure makes it especially sensitive to this transition. Because its paper market is highly leveraged relative to the physical base, confidence plays an outsized role in maintaining balance. As long as participants trust that physical availability can be accessed if needed, paper exposure can expand safely. When that trust becomes conditional, the same exposure feels heavier. This does not require fear. It only requires uncertainty. In such environments, market participants adjust quietly. Some shorten duration, others reduce reliance on assumptions about rollovers or delivery optionality. Inventory data is read more carefully, not because it has changed dramatically, but because its interpretation has. These adjustments are often invisible to headline-driven analysis. From the outside, the market may appear stable, prices may consolidate, volatility may compress. But internally, the reaction function has shifted. This is why silver's move raised questions the market has not fully addressed. The question is not whether demand was strong enough to justify the price. The question is whether the system remains comfortable operating with the same degree of abstraction it relied on before. Confidence-based constraints tend to surface in specific ways. Liquidity becomes episodic rather than continuous. Moves occur more abruptly once thresholds are crossed. Reversals are sharper because positioning is lighter. The market becomes more sensitive to marginal developments, even when fundamentals appear unchanged. This sensitivity is often misinterpreted as speculation. In reality, it reflects recalibration. Participants are learning where the new boundaries lie. Importantly, this phase does not resolve quickly. Confidence, once narrowed, is rebuilt slowly. It requires repeated confirmation that assumptions still hold. Until that confirmation arrives, behavior remains cautious. Silver's recent behavior fits this pattern. The move toward $90 did not trigger immediate follow-through or collapse. It triggered evaluation. Participants began testing whether the market could absorb the repricing without friction, whether physical signals would adjust, whether liquidity would return unconditionally. The answers have been mixed. Mixed answers prolong adjustment. They keep the market in a state of watchfulness. And watchfulness is where mispricing can accumulate, not because markets are wrong, but because they are operating under revised assumptions. For professionals and researchers, this is the most important takeaway from this chapter. The significance of silver's move lies less in its magnitude than in what it revealed about confidence. When confidence becomes the binding constraint, price becomes a messenger rather than a guide. Understanding that shift helps explain why markets sometimes feel uneasy even when prices stabilize. It also explains why subsequent moves can appear sudden. The groundwork is laid quietly through behavior long before outcomes become visible. To understand where this process leads and why markets often underestimate its implications, we need to examine how prolonged confidence constraints eventually force a reassessment of structure itself. As confidence constraints persist, markets begin to lean less on explanation and more on structure. Narratives still circulate, but they lose their ability to anchor behavior. Participants stop asking whether a story makes sense and start asking whether the system can support the positions implied by that story. This is where silver's recent move becomes structurally important. Narratives around silver are plentiful: inflation hedging, energy transition demand, geopolitical fragmentation, monetary debasement. None of these explanations are new, and none of them changed meaningfully in the days leading up to the move toward $90. What changed was the market's tolerance for relying on abstraction. Paper markets are, by design, narrative-friendly. They allow exposure to be expressed without immediate engagement with physical reality. As long as liquidity is deep and confidence in settlement remains high, this abstraction is efficient. But when confidence narrows, abstraction becomes a liability rather than an advantage. In silver, this liability shows up faster than in many other markets. The gap between paper claims and physical availability is wider. The supply response is slower. The industrial base is less flexible. When conditions tighten, the system has fewer levers to pull. This is why structure begins to dominate behavior once confidence becomes conditional. Participants are no longer reassured by stories about why prices should behave a certain way. They care about whether positions can be carried safely through time. As this shift takes hold, markets start to behave differently, even if prices do not move dramatically. Liquidity providers demand clearer signals before committing balance sheet. Hedging strategies become more conservative. Optionality is priced more highly than directional exposure. These changes are subtle, but they are cumulative. Over time, they alter the market's response to new information. Developments that would have been absorbed easily under full confidence now produce disproportionate reactions. The system has less slack. This is often the stage where observers mistakenly conclude that the market is fragile. In reality, it is constrained. Constraint does not imply imminent failure, it implies heightened sensitivity. Silver's structure makes that sensitivity visible. Because it cannot rely on rapid supply expansion or unlimited inventory mobilization, it responds quickly when assumptions are tested. The move toward $90 was not just a response to demand, it was a response to the realization that existing frameworks might not be sufficient. This realization does not require consensus. It only requires enough participants to act as if the old assumptions no longer apply. Once that happens, behavior changes even if prices stabilize. Importantly, structure-driven markets do not resolve uncertainty quickly. They manage it. They operate with tighter margins, shorter horizons, and greater emphasis on timing. This can persist for long periods without dramatic outcomes. But it does change the nature of risk. Risk becomes less about direction and more about alignment. Are paper signals, physical behavior, and liquidity conditions reinforcing each other, or are they pulling apart? When alignment weakens, markets remain functional but become less forgiving. Silver's recent move highlighted that alignment cannot be taken for granted. The market has not yet fully addressed what that implies. Narratives continue to circulate, but structure is quietly asserting itself. To understand how this tension eventually resolves or forces a more explicit reassessment, we need to examine what happens when markets can no longer rely on deferred resolution and are compelled to reconcile paper abstraction with physical reality. The final stage of a move like this is not acceleration, it is recognition. Markets eventually reach a point where they can no longer treat divergence, constraint, or hesitation as temporary inconveniences. They must decide whether the existing framework still works or whether it needs to be adjusted. This is where silver's move toward $90 leaves the market today. The repricing did not break the system. It exposed it. It forced participants to confront how much of the silver market's stability rests not on abundance, but on confidence in abstraction. As long as paper markets can intermediate freely and physical constraints remain distant, that abstraction is efficient. When confidence narrows, abstraction becomes fragile. What the market has not fully addressed is whether the recent move was an anomaly or a signal. If it was an anomaly, prior assumptions will reassert themselves. Paper pricing will regain primacy. Physical signals will fade back into the background. Liquidity will become less conditional. If it was a signal, the implications are more subtle and more consequential. Signals do not demand immediate resolution. They demand adjustment. They change how participants size risk, how they interpret data, and how much uncertainty they are willing to carry. In silver, those adjustments are already visible in behavior, even if they are not yet reflected in consensus narratives. The unanswered question is whether the market can continue to operate comfortably with a growing gap between paper pricing and physical confidence. That gap does not need to widen dramatically to matter. It only needs to persist. Persistence changes expectations. Expectations shape behavior. Behavior, over time, reshapes structure. This is why the move toward $90 should not be reduced to a debate about tops, bottoms, or momentum. Those are trading constructs. The more important issue is whether the market remains willing to treat physical availability as a secondary consideration rather than a binding constraint. For professionals, academics, and researchers, this is the lens that matters. Silver is not just repricing demand. It is repricing assumptions about how far abstraction can stretch before reality asserts itself. Markets rarely confront that question directly. They circle it, they test it, they defer it, but they do not escape it. If confidence in abstraction is restored, Silver's recent move will be remembered as a volatile episode. If confidence continues to narrow, the move will be remembered as an early signal that the framework itself was under strain. At this stage, the market has not decided. That indecision is itself informative. If this analysis has helped clarify why silver's recent move raised questions the market has not fully addressed, consider sharing it with others who examine markets through structure rather than sentiment. And if you've observed similar dynamics in other assets, where price moved ahead of explanation, add your perspective in the comments. Markets speak in behavior long before they speak in conclusions. Silver has spoken. The question now is whether the market is prepared to listen.